Now watch. This is a very strong entry mechanism. I don't know why you guys keep asking me for entry techniques when I give you bangers. Like they're just nobody's getting you entry signals like I give you. Okay. So at 9:30, we opened, traded lower, and then started to run up here, came back down into this inversion, which is a bullish fair value gap first. Used it here, traded down through it, didn't offer any kind of premium sensitivity, traded above it. The body's respecting it, even though we wicked through it. Look at the body staying in the upper half. The market rallied up, took out that high, relative equal highs over here, and then created this little bit of a range. Now, this whole business in orange, that's the daily suspension block this showed over the last couple days in NQ. And when price was traded right to that, and we took out these smooth highs here during, this is the key point here, during the macro time, smooth edges in here. Candlesticks high for this candle here. Buy side of out, sell side efficiency, and failed. So as it hit this in here, I was trying to be short right at as it hit the level, trying to time it as the market would tick to it. I wasn't exactly able to do that, but I got real close to it. And then one more candle. And these types of things here, when the next candle goes just a little bit higher than the candle I entered on, those are things that I grade my execution on. Now, I'm not beating myself up, but I like to have the high candle if I'm shorting. The fact that we had a lower body is one of those things I cheerlead myself and say, well, the bodies didn't go any higher than my entry candle. So it went one more time, wicking through it. And then we had a nice displacement lower, as you saw in the recording. So there's your first presented fair value gap. And consequent encouragement is not touched there. Rallies up. Same premise. Now watch. This is a very strong entry mechanism. I don't know why you guys keep asking me for entry techniques when I give you bangers. Like they're just nobody's getting you entry signals like I give you. Okay. And I'm not saying I'm telling you where to buy at live market conditions. I'm telling you how to find them on your own. That's superior to just copying somebody. Okay. I already proved my stuff works, and students all around the world prove it. They make money with it. Okay. And they're the highest paid ones that's out there in the prop firm industry. So there's that. The fact that we couldn't get into consequent encouragement there, that's brilliant. But now we have that wick. Okay. Same idea. We're going to use this right there, draw it down to the below that wick. Is it touching consequent encouragement? No. That's perfect. That's a strong qualification that it's going to go higher. Now, notice what I'm doing. I'm teaching you order block theory and entry mechanisms around them after they're validated. That's changing the state of delivery. Now I'm teaching you when the fair value gap forms. It's the first presented fair value gap. Is there anything different being applied here? No. You're waiting for it to come down into it. Is it trading in the lower half? No. Is it leaving a body in the lower half? No. Is that strength or is that weakness? It's strength. It's validating this inefficiency. So we have this area in here, same premise. You have the wick that works into the fair value gap. So from the open of that candlestick, which is the body, down to the midpoint, consequent correction of that wick, anywhere in there that you can afford to get a long on, and use the low of that wicks as a stop. It's simple as that, folks. It's simple as that. And then once you have that, where's buy side? Right above here. Okay. It runs up, tags it right there. Beautiful. Then market trades lower, back down into the suspension block, and then trades significantly higher outside of the bearish fair value gap on the daily chart. We have a shift in market structure there. And now consolidating buy side right there. I like that. Look at this wick here. See that wick? And this wick here. This is all back and forth type price action. So this is going to act like a balanced price range. And it's taking buy side. So anyone that's short that trailed their stop loss there, they came right back for them there. What's this over here? Relative equal lows. So they dive down in here. We have a fair value gap there with a suspension block at the high. There. And then that's the business on that one. Sells off. Look at the bodies. See how they're not touching consequent encouragement? See that? I know it's a little difficult to see. I apologize, but let me see if I can change the color and see if that helps any. And we'll bring it to the front. Send it to the back, rather. There you go. See how it's below? Let me just, there you go. See the contrast there? The bodies are not touching consequent encouragement. You got to include the volume imbalances, okay? Market dives down. Sell side resting right here. We dive down. We got that. Beautiful. And then in the PM session, we get a little bit of a wild price action run up in here. Sell side taken. Look at these smooth highs here. And then rallies up. It's this high, rather. That high and that high. I was talking and I touched this area here. It was really me this trying to talk about that and that high. So there's buy side trailed to that. They stabbed up there and got it and then broke lower. And I don't know if you hear it, but Piper is snoring like a lumberjack. Good gracious. So anyway, we have a bearish fair value gap here. Trades up into that. And again, this is the overlap between that daily fair value gap that's bearish and the suspension block. The suspension block high is this right here. This right here. That's why it's shaded a little bit different. There's pink. There's this weird, like salmon colored, and then there's like an orange hue. Orange hue is the daily suspension block. The salmon color is the bleeding between the bearish fair value gap in pink and the daily suspension block. Now I know it's a whole lot of stuff, and there's other ways that you can trade that are very simple, but simple isn't always precise. Simple isn't always as reliable. Okay, there's a trade-off when you want to do simple model, simple this and simple that. I look at it this way: flipping a quarter and buying on heads and shorting on tails is as simple as you can get. Why aren't you doing that? Because you don't have any faith behind that. So what are you going to subscribe? You're going to subscribe faith to things that really aren't making price go up and down. So when you look at these things I'm teaching you, and it could be a whole lot of stuff on the chart like it is. This is a very busy chart. But again, I'm showing you the levels that I would have on my notepad. It's the high of this, the low of this, these levels up in here on the bearish fair value gap, and the quadrants and octants on the daily suspension block. They're utilizing them here. Look at the fair value gap here. See that? Look at the fair value gap there. How do you know? You see all these guys that use my name because they want the traffic, but when you turn into listen to them, they're always trying to correct me or tell me I'm doing something incorrect. But I'm the one that created this stuff. I don't get it. But I understand you're trying to make a name for yourself. But you got to stop lying, man. You got to stop what they call it. You got to stop the cap. So we have this area right in here. So the close of that candlestick comes in at 146.5, and the open comes in at 146.5. So we got to go up to the wick. So there is no volume imbalance on the low. There is a volume imbalance, or no, is there? The open, 165.5. The open on this. So yes, there is a volume imbalance there. Let me make sure I don't trust my old eyes. No, I don't know what I'm talking about. So we're going to use the low on that wick down to the high of that wick. Okay, so there's your fair value gap. Now, where's the fair value gap forming? It's at the low of the overlapping between the bearish fair value gap in pink and the suspension block. You see that? So how do we validate fair value gaps? Well, we don't use volume profile. Okay. And there's a lot of guys out there trying to say, this is how you find the real fair value gaps. Wrong, 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 wrong. The fair value gaps are either first presentation, and if they're not first presented, then they are always anchored to a octant or a quadrant. Period. I don't care what you want to make it sound like or seem like because you want to sell some course or you want to sell some traffic, coming to your channels or whatever it is you do. If you're listening to anyone tell you that volume profile and a low volume node, sometimes they might agree, but that's not the logic. That is not the logic. The logic is it's anchored to a quadrant level or a low, which is what? It's part of the range. So this bleeding over here, that creates in effect another PD array. Ooh, shadow. That's what it is. It's a shadow. Okay. A PD array simply called a shadow because it's casting a shadow over top of another imbalance. So this shaded area in salmon, you can grade that also. Now I'll just do it just for spits and giggles. Okay. We'll do that right there. And then we'll add all of these. I know you guys like to get my fib levels. Don't tell anybody what they are, okay? You start sharing this on the internet, and my whole scheme's been exposed. All right, so the market trades down. Look at that. It's that right there. That's the upper quadrant of that range. Now, you wouldn't look at that range. Supply and demand wouldn't look at that range. Volume profile wouldn't look at that range. Footprint wouldn't look at that range and grade that like that. See that? So when we have these things form like this, you have the opportunity to then measure any PD array that lays down. That means it has to be touching. It could be the high or the low or anywhere in between, but it has to be touching it. That means it's anchored. Here is a wick. Right there, you see that? We open, immediate rebalance. Creates a volume imbalance, but look at this candlestick's low. See that? 30,175 even. What's the candlestick high on that? 30,175 half. So it went 2 ticks up there to meet that and trade back to this candlestick's close. Close is 175.25. To get that price, you're going to have to go 1 tick above it. And that's what you're getting there. 175.50 or 1 tick higher than quarter. Fails to trade lower, but it's working inside of the volume imbalance right there at that candlestick's open. Look at that, 173.75. So 173.75, this candlestick high, 173.75, volume imbalance. Perfect. You're not getting that with order flow. You're not getting that with volume profile. You're not getting what Elliott Wave. You're not getting that with Wyckoff. You're not getting it with GAN. You're not getting, you know what I'm saying? I could go through the whole gambit here. Everything else is second fiddle. Okay. And it's not me bragging. I'm trying to encourage you to just understand that you're light years ahead of everybody else learning what I'm teaching you for free. For free. Isn't that nice? It's almost like I don't need your money. So we have this fair value gap here. It's anchored to the low of that shadow, which is a bleeding over of 2 imbalances. Trades lower. Look at this. Oh, here we have another fair value gap. Maybe there was a low volume node there. No, there's your level. It's an octant. Okay. That's what makes it valid. I know you guys don't want to believe it's just this easy, but you got so used to calling what I teach complicated. It's really not. It's complicated if you want shortcuts. It's complicated if you want a 5-minute trainer. But here we have it. Sells off. In here, we have another fair value gap here. Now, this is where you have to use like 16ths. Yeah. We can go down between the octant and the quadrant and split that in half. Yeah. You might want to start doing that. I'm not going to do it because it's too good. But all you guys out there should start doing it. Okay. And then we create these relative equal lows here. And we're now just sitting right here with regular trading hours now closed. And what is it doing? It's running after a macro. The macro starts over there. And then it goes and creates that low at 6 minutes after 2 p.m. Eastern time. Changes state of delivery, validated. Does not need to close above it. Why? Because it's taken, look at these smooth lows here. See that? That's sell side being taken, purging it. It's kind of fun seeing this stuff work like this all the time. And then it trades above that opening price. As soon as it trades above it, it validates this as an order block. So when it trades back down into it, it happens on this candlestick here. Okay, trades down into it there. You could take that on a long. If you don't have the conviction for that, then just use the close of that candlestick to the consequent encouragement. Anywhere in there is a long. Isn't that nice? Real easy, simple strategy. Highly, highly precise. And then you can simply just use the low of that wick because it shouldn't go below consequent encouragement. And you frame your risk between this candlestick's low of that wick to whatever your entry would be in the upper half to consequent encouragement of that wick. So it would look like this. Anywhere from here to there. Okay. And you can see they reclaimed that area again right there. See that? One more time right to the top. See that? And where's buy side? Right there. So here, we're trading back down into it again. Where's price go? Rips higher. Isn't that wonderful? Goes a little bit higher. And then finally, the last hour trading. Now we have some weakness in here. This candlestick, see that? We have breaks above this, trades above it, and uses this as a bullish fair value gap right there. If we trade down below it like we do over here, that validates it as a ICT inversion fair value gap. So that's what it starts with there. So unless it doesn't get a consequent encouragement, which is nice. So it's moving higher, but then it gives up the ghost because it's been long in the tooth all afternoon, going higher, higher, higher. So this is going to act as a inversion fair value gap in the future. So you got to be mindful of it. Why? Because it's trading above this high here, and now we have to blend time and price. Okay. Meandering around here, takes buy side there, it gets real sloppy here, and then watch. Right here, during the merger on close or market on close, last few minutes of trading in the last hour, it rips lower, comes right back up, hits it there. There's your inversion fair value gap for MOC. Market on close is very algorithmic when it does that. Down in here, we have a wick. Price goes below it there. You want to grade that. See that? That's consequent encouragement. We don't want any bodies above that. See that? Isn't that brilliant? Sell sides here, goes lower, down into 450. And then that's a macro time. And it goes right back up into the range in this inefficiency. There's buy side here. They keep relative equal highs here, and then they pump it up to clear that. And then they take that buy side I just gave you on the highs. And then it gets ugly during the Asian session.